In 2026, the average Chinese citizen earns over $3,000, while the Indian citizen earns $500. But scrub back to 1960 and the lines cross. 60 years ago, the average Indian citizen earned twice as much as their counterpart in China. Post-independence India began with a clear lead. It possessed an expansive railway network, established industrial centers, and the broad support of global economists. During the same period, China was trapped in famine and political instability, with much of its workforce restricted to manual labor in rural clay kilns. This raises a difficult question. How did one nation transform from a starving agrarian society into the world's second-largest economy in a single generation? The answer lies in two distinct strategies for mobilizing human capital and engaging global markets. In 1978, Deng Xiaoping rose to power and prioritized global integration. He understood that China's path to becoming a superpower required opening its borders to foreign investment. China established special economic zones along its coast. Within these zones, the government ruthlessly cut through red tape and offered massive tax incentives to attract the world's largest brands. India took a different route. Throughout the 1980s, the license Raj created a suffocating bureaucracy where opening even a small factory required dozens of government permits and years of official approvals. This was the era of import substitution. India restricted foreign trade to encourage local production, but without global competition, domestic manufacturing became sluggish and inefficient. China focused on the bottom of its population pyramid. They funded primary education on a massive scale, creating an army of literate factory workers. India's strategy was top-heavy. The government funded elite universities, but left the rural majority without basic education. These two factors, closed borders and a neglect of mass primary education, ensured that India would fall behind in the 20th century race for industrial dominance. By 1991, India reached its breaking point. With only enough foreign currency to pay for a few weeks of imports, the nation faced total economic collapse. To avoid bankruptcy, India implemented the LPG reforms: liberalization, privatization, and globalization. For the first time in decades, the Indian market was open to the world. This opening allowed India to leverage its earlier investment in elite education. Thousands of highly skilled, English-speaking engineers drove a massive boom in the IT and service sectors. However, the service sector alone couldn't provide enough jobs for the masses. While China built hyper-organized factory floors to employ millions, India's manufacturing sector remained stagnant due to poor roads and unreliable power. The software boom saved the economy, but the lack of a manufacturing base meant millions of lower-skilled workers remained trapped in rural agriculture. The momentum has now shifted. China's 40-year period of explosive growth is ending. China's population is aging rapidly, and its labor is no longer cheap. This chart shows the sharp rise in median age and labor costs that are currently eroding China's competitive edge. Global companies are also losing trust in China's centralized control. Many are now following a China Plus One strategy, actively moving their manufacturing units to other countries to protect their supply chains. The same centralized scale that made China a superpower has created systemic risks that are now driving investors away. India is now moving to capture this business. New policies like the production-linked incentive schemes have encouraged companies like Apple to move high-end electronics assembly to Indian soil. The government is also correcting the logistical failures of the past, pouring billions into a modern network of highways, ports, and high-speed railways. This infrastructure is finally meeting India's demographic dividend. India now has the world's largest youthful workforce, ready to enter these factories at massive scale. India is also exporting high-value technology, such as the BrahMos missile system, which is currently being sold to over 90 different nations. China's top-down factory model defined the previous era of production. By synchronizing its new infrastructure with the world's largest youth workforce, India is now claiming a central role in the global supply chain.